You can make as much as 12%, 14%, and even 17% returns with crypto interest accounts. But are these returns too good to be true? So what's stopping people from borrowing money at 4.5% or lower on different platforms and piling it all into crypto interest accounts, profiting you enough free and guaranteed money that you can pile up and dive into? I mean, why should we park our hard-earned emergency fund money in something like Ally Bank making 0.5% interest? Or even the S&P 500, which has historically made us about 7% interest and is pretty volatile, when you have things like BlockFi making you an 8% return, and it appears to be a guaranteed thing, right? To answer these hot topic questions, I'm going to explain how companies like BlockFi, Coinbase, and Voyager Digital are able to afford paying you a higher rate of return than they're lending out to other people. And I'm also going to explain why I believe there may be an impending crypto interest rate crash coming. Let's pretend I'm a company like BlockFi, and I want to make money by lending out crypto to other people. So I go ahead and find somebody who's looking to borrow $50 from us and is willing to accept a 5% interest rate. Most people would assume at this point that if we have $50, we can go ahead and do the deal all by ourselves, but that's not how businesses work. I would need more than $50 because I have other things to pay for, like salaries, research and development, and just keeping cash and reserves in case of an emergency. So let's say I put everything together and, considering my risk tolerance, would be willing to do the deal if I had $100. But what if I only had $99? What do I do then? Well, that's where you and these crypto interest accounts come in. So let's just say for that extra dollar, I'm willing to give you an 8% return, and you accept. So you give me $1, I now have $100, and we can do the deal. Of the $100, $50 is going to go into the business, stay in reserves, whatever I want to do with it, while the other $50 is going to go to our friend here at 5% interest. Let's look at what happens after a year's time. Well, $50 at 5% interest is going to make me, BlockFi, $2.50. But remember, I still owe you 8% of $1, or 8 cents. So I made $2.50, I lose 8 cents, and I profit $2.42. This is how companies like BlockFi can afford to give you a higher rate than they're lending out, as long as they make money at the very end. But there's a huge problem, because rates dictate everything. And if you let each side compound for long enough, it'll get to a point where I owe more money than I'm making. So something's got to give. And usually it's not good for this guy. We've already seen these companies decrease their rates before, so it shouldn't come to us as a surprise if they were to do it again in the future, especially after showing you how the business model works. This is mirrored by the fact that these are new companies trying to break into a new industry, and as such are offering overly generous promotional rates as a way to entice people onto their platforms, gain early market share, and be the first company you think of when you think of crypto interest accounts. Some companies have even gone so far as to operate at only break even, and some companies even worse than that. Now, there are many ways a company can make up the difference, one of which is by offering you a lower rate of return. So instead of 8%, they might offer you something like 4%, which means by the end of the year, they will have given you not 8 cents, but instead they'll give you 4 cents. And if we take the $2.50 that we get in profit from lending out money and subtract the 4 cents, instead of profiting $2.42, we'll actually make more money. We'll make $2.46. This is one way they can make up the difference. Another way these companies can change their model so that way it's more sustainable is by increasing the rate they ask from lenders. And in this case, we'll just say 6%. That would mean our money we make goes up and our profit goes up, which would make us more money at the end, right? Well, it's not so simple. Because what if the lenders want to maintain the same profit margin? It's harder because we're asking more money from them.
I made money, I spend money.
So typically that means they have to do riskier things to get a higher return, which might not pan out, which means we might not get paid. And if they're okay with decreasing their profit margin, that means again, they might have less money and means we might not get paid. Additionally, because we're increasing our rate, they might go to another competitor that has a lower rate, or they might just ditch the effort altogether. It's a really hard balancing act. Now, I've gone through a ton of financial statements, and in reality, they're not actually doing something as linear as this. What really happens is they're diversifying where they're lending money to. So that 5% return that you see on their website isn't the only place they're getting money. They might also be lending out to institutional investors at something much higher, like 10%, and then having some kind of mix here. So it could be like 60-40 or 70-30, and they can change what percentage they're comfortable with. Additionally, they might want to play it more risky or more conservative. So where we asked for $1 here, they might want to play it more risky and ask for $10 and only have $90. That would be more risk. Or they can take on less risk. And really, instead of asking for $10, they might ask for 10 cents and have $99.90. That'll make them less risky. So there's a ton of ways you can play. So yeah, they have a ton of tools at their disposal. I mean, they could also do things like adding tiers to accounts or change the loan to value they require and even sell off your user data. But there is one tool that is their absolute favorite, and it affects you in a huge way. So if you had to guess what the #1 source of revenue is for a company like Coinbase, what would you think it is? Well, I dove into the S-1 filing of Coinbase, a document they must file with the SEC when they want to go public, and found out that 96% of its revenues came from fees. And like I said, Coinbase is not the only one to do this. I dug into the financial statements of Voyager Digital, and I found that 89% of their revenues also came from transaction fees, which brings up an interesting study into human psychology. If you had the option to choose between an account that gave you 1% or an account that gave you 2% with a 1% fee, what do you choose? Well, I mean, they're the same mathematically, right? But psychologically, sometimes we place a higher perceived return on the account with the 2% interest rate, just because we don't really take into account the fee. And that's kind of what these businesses are doing to us. In fact, many times on this channel, we've talked about the pitfalls of using APY, and this is just one more example. APY will not take into account things such as fees, taxes, leap years, or timing and cash flows, which are important, and so much more, by the way. So I feel that most people, when they look at crypto APY, they try to compare it to banks, and it's not always synonymous. We can't use APY to compare to another opportunity. APY is just not comparable. If you decide that you want to park money in these crypto interest accounts, then I highly recommend you pay very close attention to the fees you're charged and the risk tolerance of the company you've decided to give the money to. If I were to give you a general sense of what I'm seeing these crypto interest companies are doing, I would say that most of them are finding institutional clients that are willing to accept a very high interest rate on a loan to go and do some pretty risky things, and then the interest companies will then pass along their profit to you and charge a fee at every step of the way. Crypto industry as a whole has huge potential, but I pay very close attention to the risks and each step along the way. Additionally, I was recently reading Margin of Safety by Seth Klarman when I saw that he was talking about the junk bond era in the 1980s. In that time, speculators drove up market prices for junk bonds like crazy because they were promising super high yields, which inevitably ended up crashing in on itself. I believe that these crypto interest accounts draw many parallels to this junk bond era in the 1980s, and if I were investing in these crypto interest accounts, I'd do well to study that debacle. Personally, I like to look at crypto interest accounts more as an investment than a place to put your emergency fund, especially knowing the back end of how these companies operate and that they're not FDIC insured. Also, as an investment, I would want to see a longer history of performance before I put my money into them. And I would if I saw that the after-tax money-weighted rate of return was my best opportunity cost. But that's all I have for you in this video. If you like the content, make sure to check out our other video explaining why we should not use APY and this video that YouTube recommends for you. Thank you so much for watching, and until next time.